Hello, everyone. My name is Tez Roro, real estate professional in the state of New Jersey. I'm here today with a mortgage professional to answer your burning questions about refinancing. So, with rates being so low, a lot of people are thinking about refinancing, and I'm sure there's a lot of questions that go along with that. So, my guest today is Mark Yecies, who is the founding partner at SendQuest Funding. Hi, Mark.
Hi, how are you? Thanks, Tez.
Of course, of course. I love that you're in your practice, you love to educate. I always have a lot of questions about the behind the scenes, which is why I thought you'd be a great person for this. So let's get right into it. Rates are very low right now, both for people who are looking to purchase and to refinance. So what do people need to consider when thinking about refinancing?
Well, they have to consider the costs associated with refinancing and how quickly it will pay off and the term of their loan. In other words, how much time do they have left? What was the original term of the loan and so forth, and the value of their home.
Yeah, which gets me to think about when does it make sense, right? So when we think about refinancing, we often think about if your rates are low, let's say, I don't know, I have a 4.5% interest on my mortgage, and if I'm able to get a 3% or something, it seems like a savings, right? At 1.5, and so maybe save a couple $100 a month, and that's substantial, right?
Right.
Now, as you said, there are associated costs with refinancing. It's not just lowering the monthly payment, there's closing costs and things like that. So can you help us understand a little bit about how one might go into analyzing or determining if, refinancing and lowering the rate may make sense for them?
Sure. So I guess the easiest way to do that is actually to talk about some numbers.
Yeah.
It costs somewhere in the neighborhood of $4,500 to $5,000 to refinance a mortgage. And people say, well, why so much? Because you have to get an appraisal for the most part. You have to you have to do a renewal on your title insurance. There's title search, there's recording fees, there's credit report, and most lenders have a fee in the neighborhood of $1,000. That's what they call junk fees, but in actuality, it helps defray the cost of selling the loan into the secondary market, meaning Fannie Mae, Freddie Mac, FHA, or what have you. In fact, our fee is about $1,100, and it still costs us $300 or $400 more than that to lay the loan off into the secondary market. So now, let's say, for argument's sake, you had a $400,000 mortgage, and your interest rate was 3.5%.
Yeah.
So if you refinance to a 3% interest rate, you're saving 0.5% per year.
Yeah.
So in interest, that's $2,000. 0.5% of $400,000 is $2,000. It probably doesn't make sense to refinance for that 0.5% because it's going to take you at least 2 years to catch up with that interest savings. Okay. Now, if you had a 3 7/8 interest rate and you were refinancing to a 3% interest rate, then it probably would make sense because you're saving almost $4,000 a year. So with that, even though you're saving maybe close to $4,000 a year in interest, especially through the first 5 or 10 years of the loan, because it doesn't pay down very much, you're not saving $330 a month in cash flow, which is $4,000 is $333 a month, because with the lower interest rate, the loan pays off or amortizes more quickly. So part of what you're doing is paying yourself back more quickly in terms of the equity you have in the loan.
Got it. Okay. So that was a lot of math, a lot of numbers. So some of the things that you said, right? So some of the costs are title, for example. So, I put on my social media, hey, I'm going to have a conversation with, a mortgage professional. What questions do you have about refinancing? And someone said, why do I have to pay all of these fees for a refi when the deed is already in my name? Fees like title search and others. I just refinance for a very low rate, but it is such a pain to pay all those loan fees. What do you have to say to that?
Well, there could be a lien that appeared against your title between the last time that you financed the house and there was a title search done, and now. And a prior lien, meaning a lien that's dated earlier, has first position, a prior position. And mortgage lenders like Fannie Mae, they have to be in first position. So you have to do a title search to make sure there's no prior liens, like a tax lien, or maybe you had work done on the house and there's a mechanics lien. those cannot be there. So we have to make sure that they're not there. And then what the title insurance policy does, the title insurance policy guarantees that there's no prior liens. So let's say you go sell the house in 5 or 6 years and a lien shows up. Since the title insurance company insured the lien, the title, they would be responsible for satisfying those liens.
Got it. Makes sense. Okay. Now you mentioned, with the example of, the $2,000 savings, it would take about 2 years or so to realize that, or for that to make sense, right? So when we put that in terms of, a lot of people say, okay, I don't plan to sell in the next few years or something like that, right? So can you help us understand how that fits in? People who may be looking to refinance and take advantage of, lower monthly commitment mortgage, but at the same time know that this is not their forever home, for example, right?
Right. Well, that's one of the things we look at. Sometimes if it's borderline, I'll say to the people, how long do you think you're going to be in this house? And if it's a short term, I'll say, well, just don't bother. They say, oh, well, my kids have 4 years left in school, and then we're probably going to get out of here because we don't want to pay these taxes anymore. I'll say, well, don't bother. But let's say they closed at 3.5, 6 months ago, and they want to refinance to an interest rate of 3% or 2.75%, then it probably does make sense, because basically it's like paying a point to reduce your interest rate 0.5 or 0.75% is the way I look at it, because they're so recently into the loan. Usually when you pay a point, which is 1% of the loan amount, which $4,000, $400,000 loan, it will only save you 0.25% in the interest rate under ordinary circumstances, like at the time you're applying for the loan. But here you're paying a point and saving, 0.5 or 0.75% in the interest rate, then, kind of makes sense. So if the loan is young, yes, it makes sense to do it. But if you're 10 years into it, it probably doesn't make sense.
So it sounds like, right? I'm sure, like, as people are listening to this, they're kind of trying to fit their scenarios into this mathematical equation to see if it would make sense. It sounds like when they reach out to mortgage professionals about refi, the conversation shouldn't just be about, this is how much you're going to save per month, but really, what are your plans, right? What are your goals? 3 years, 5 years, which is kind of the same conversation I have with my clients when they buy, is where do you see yourself 3 to 5 years? So we can talk about lifestyle, right? Beyond bedrooms and bathrooms. So let's talk a little bit about appraisals. So you mentioned, appraisals. Did you want to add something?
I'll throw one other thing in there. When you talk to somebody about refinancing, be very, very careful, because a lot of guys or gals, what have you, in my industry, they will make it sound like you should refinance, even though it really doesn't make any sense.
Yeah.
Like, for instance, if you've been in a house for 10 years and it started out at, say, $400,000, and now you only owe $320,000, that's $80,000 reduction in principal. That's that's $250 savings in cash flow right there, just based on your principal reduction. So you're not really making interest savings. Your savings on a cash flow basis is principal reduction, and you're increasing the term of the loan. So that doesn't make sense a lot of times to do that refinance. Okay, so be careful with whom you speak to.
Yeah. So which is why, hopefully people walk away with the right questions to ask, right? By the end they watch this. Okay.
Sorry to interrupt for
so
that.
No, that was an important input there. So you talked about appraisal. So I've heard, because of COVID, a lot of things have changed in terms of lending guidelines and appraisals and how they're done and what type of loan it is. And sometimes it could be, automated valuation. Sometimes they have to come out, all these things. So what are you seeing in refinance in terms of appraisals? Are people going out and into the properties?
Yes, they are. Yes. Fannie has changed some of their guidelines. They are allowing what we used to call in the old days drive-by appraisals in some instances. But we found that people do want the appraisers to come into their house because maybe they've done some improvements like bathrooms and kitchens and so forth, and they think that their home has more value. I'll just say that everybody thinks their house is worth more than it is. Okay. I mean, it is what it is.
Yeah.
A lot of times they're surprised and it appraises for more than they thought, but people want the appraisers to come into their house in a lot of instances. And particularly since we know more and more about this disease, they're more comfortable with face masks and so forth, and know that that prevents the spread of the disease, that people aren't so afraid to have the appraiser come in, or the appraiser isn't afraid to go in.
Yeah. And I'll just say that, I've talked to different, friends and clients, and I think, particularly for the in-person ones, I think it's important to maybe have like a list of, improvements that you've done, right, recently or over the past 5 or 10 years or something that may not be obvious. Some inspectors are great about asking detailed questions that may impact value. Some are not. And so I just find that it may be helpful just to have, something prepared for them to consider.
Well, there's some things that don't really affect value, like
Mhm.
a new roof or new windows
Mhm.
or new furnace. They just don't affect value, because when somebody buys a house, they expect the roof not to leak, they expect the windows to work, they expect the furnace to work. But new bathrooms, kitchens,
Mhm.
additions, things like that can affect the value. And beware that if you put a new addition on your house or a new deck, you will have to get a survey for a refinance, because the footprint of the structure has changed.
Got it.
And that's another $750 or $1,000 that you might not have expected.
Yeah, but also, if that person plans to sell, that's actually a helpful document to have. It's a value add, right, from a seller
Yes.
perspective.
Yes.
So, okay, cool.
And and
Um, yeah, go ahead.
there's one other thing. Fannie has also, in some instances, allowed appraisal waivers.
Hmm.
So what will happen, and it only works for regular rate and term refinances where you're just either changing the term or the rate, not if you want to take equity out of cash out refinance.
Hmm.
So in certain instances, they have enough statistical information to know if a value is good or not, and they
Hmm.
will just have an appraisal waiver.
That's actually an interesting comment, because one of the other questions that I have from social media is it worth refinancing an FHA into a conventional loan if you plan to sell in the next 2 years? I think there's two questions there, right? We touched a
Yeah.
little bit about the 2-year period, if it makes sense to refinance or not, regardless of what mortgage product you get. But then specifically here, someone is talking about FHA into conventional.
Yes. Well, most of the time, it makes sense to refinance an FHA into a conventional for two reasons.
Hmm.
Many, home values have gone up, so you may have more than 3.5% equity in your house. So if your credit's decent, really one of the biggest reasons to be in an FHA loan is A, you only have the 3.5% to put down, or B, your credit is below 720, and with the high loan to value, the low down payment, the rate and the mortgage insurance are exorbitant, so then FHA becomes less expensive.
Hmm.
So let's say you're in your house for 3 years and you have a 3.5% FHA interest rate. Well, you also have 0.85% per year in mortgage insurance.
Hmm.
So the effective rate you're paying is 4.35% between the 0.85% and the 3.5%. So if you can refinance, let's say you've now got 10% equity,
Hmm.
okay, because it's 3 years later. So now you can refinance into a conventional loan. The MI goes down from 0.85% to somewhere around 0.2%,
Hmm.
depending on what your credit scores are. And it's no longer permanent. FHA mortgage insurance is permanent.
Now,
So
let me stop you there. When you say permanent, does that mean that it does not get, you don't get to refi out of it until you have paid 20% or the equity reaches that 80/20?
no, it means that it doesn't matter how much equity you have in the house. If you put less than 10% down at the time you purchase the house with an FHA loan, there will always be mortgage insurance on the house as long as you have that FHA loan. Okay. Once
Okay.
you right, the FHA mortgage insurance, which is called mortgage insurance premium. Okay.
Now, once you hit 20% equity, right, between down payment and payment, can you refi out of it?
You can refi anytime in between, anytime. And the reason that it's a good idea to refi out of an FHA loan is because if your credit's decent, more PMI as opposed to MIP. PMI is what FHA loans, Fannie Mae loans get. MIP is FHA loans. The premiums, because it's an insurance policy, just like any other insurance policy, you pay a premium and you pay 1/12 of the annual premium every month. The premiums are in many instances less than a quarter of the price of mortgage insurance premium. So you're paying a much lower premium for the mortgage insurance, and it goes away once you have the equity in the house.
Okay.
With an FHA loan, it doesn't matter how much equity you have mortgage insurance for the life of the loan.
Okay.
Another difference between the FHA mortgage insurance and the Fannie mortgage insurance, FHA mortgage insurance, you pay the premium based on the balance on your loan.
Mm.
But with the Fannie mortgage insurance, the payment stays the same as it was at the start of the loan.
Mm.
Okay,
And
am I
when you
making
say Fannie,
sense?
you're talking about the conventional products.
Right. But the conventional product is so much less expensive, and it goes away when you have equity in the house.
Got it.
It makes a lot more sense.
Okay. So it sounds like the short answer is if we're talking about FHA, the conventional, it makes sense. The person just needs to figure out if that 2-year period makes sense for them, with
Right.
the cost and things like that.
The
Got it.
life circumstances surrounding it. Correct.
Excellent. All right. Now, how long, is a refi taking nowadays? And maybe within that, you can cover some of what may have changed in underwriting rules or regulations because of COVID. I understand that perhaps, some products are pulled from the market to minimize risk, and credit scores or DTI, may have changed. If you can touch a little bit on those.
Sure. What's changed recently is that pipelines are overfull. There are more loans in the system than the system can handle.
Yeah.
There's a shortage of manpower in our industry because you have to know what you're doing. You have to be trained. It's a very technical area to be an underwriter or processor in the mortgage industry, and it's kind of a catch-22. We don't have enough people. We need more people, but we're too busy to train new people, if that makes any sense.
Yeah.
So pipelines are overflowing. Purchases are still taking a relatively normal amount of time, but because people have to get into houses, refinances are not. Underwriting with most of our investors is taking between 30 and 45 days for refinances, which means that you're not going to close in under 60 to 90 days for refinance. It is what it is. It's frustrating. We have a lot of pissed off borrowers.
Yeah.
Because the things are taking too long.
Yeah.
Many of our investors are extending lock-ins.
Yeah.
Great.
Yeah. And so can you say a little bit about that? Does that impact, I read that there's something about a 0.5% additional cost being implemented to one of the products to kind of.
That's actually not exactly right. Okay. What's happened is the FHFA, which is a mouthful, say that 5 times fast, is the regulatory agency that governs Fannie Mae and Freddie Mac, the federal regulatory agency. What they decided is that lenders are making too much money on refi, so they're going to start charging them 0.5% per loan.
Charging the lenders.
Yes, but lenders are not making that much money on refinances, so it's being passed along to the borrower. So essentially, and this is for loans that are being delivered in December, right? Which means that those loans are closing now, which means that it's already in place.
I see.
Okay.
Okay.
So it's essentially an 0.1% difference in the interest rate to a borrower, because that's building 0.5 point in, 0.1% in the rate. So you can write a letter to your senator or congressman and complain about it.
The change.
The change. I don't know how they could just decide that it was okay to stick their hands in our pockets, but they did. Okay.
Got it. So now going back to some of the changes, I know that I think credit scores were increased, right, for some of the portfolios? Not
really. There still are some lenders out there doing an FHA down to 580. Let's put it this way: if you have a 580 credit score, unless you have terribly extenuating circumstances, you're not paying your bills on time. Okay. So you probably shouldn't get a mortgage anyhow.
So right? You know what, can I stop you there? And I love to learn the behind the scenes as well. So when we say some lenders, right? So we know that there's sort of federal guidelines for lending. Yes. And then I'm assuming each lender then has their own, underlays or whatever they're called. Is that what's allowing them to, like, why would some lenders be still accepting clients with 580 but others wouldn't? Is it an internal risk factor?
Yeah, yes. And I can tell you that in my experience, when we have an investor that says, oh, we'll do this or we'll do that, and it's sort of outside the box and risky, those loans never close. Like they're using that as kind of like a loss leader to give them other business.
Mm.
Yeah, I have never seen a 580 credit score that was creditworthy, frankly. And so you can get 600 down to 600 for FHA. Fannie and Freddie go to 620, but even with a 620 credit score, the costs become onerous because Fannie and Freddie have what are called loan level pricing adjustments. As the loan to value or the amount of equity you have in your house and your credit scores and the loan type and the property type change, they charge premiums in the rate. So for instance, if you had a 680 credit score and you were putting 5% down, they're charging like 3 points on the loan. So you're going to pay a point or a point and a half higher interest rate with that kind of a credit score. So you might be better off with FHA.
Got it. The golden rule is protect your credit. Shameless plug. I have done a video on the anatomy of the credit score and how to improve it. So it'll be on YouTube or the several platforms. And so, I think having good credit is just a timeless asset to have, right? Regardless of if lending guidelines change or not, that's just something good to have.
Right.
Okay. So now that we talked a little bit about those, let's talk about what type of loan products you offer. Sunquest funding, right? What type of clients do you help with?
We like to do, well, we're what you'd probably call generalists, but we do the regular Fannie Mae, Freddie Mac, which is, the 5%, 10%, 20% down, 30-year fix, buying a house. And we have FHA, we have VA, we have USDA, which are those are government insured products. Okay, so the funding fee or insurance that you pay through those products help the government, the US government, guarantee those products. I think, you can get a mortgage anywhere, Tez. I mean, you really can. It's a commodity these days.
Yeah.
So for us, it's all about keeping the process transparent, helping people understand where do interest rates come from, what affects the market, where do guidelines come from, why are you asking for this, why are you asking for that, so that people understand how the process is working, because a borrower has no control over the process, but understanding how the process works helps in my experience, our borrowers feel more comfortable going through the process.
Yeah. Okay. Good. And what advice would you give to consumers who are either looking to purchase or to refinance, given the certain, the circumstances that we're in?
Right. The most important thing is to find somebody that you can trust, that has experience and is I know it's redundant, but is honest, is ethical. There's a lot of pretenders in our industry. And it's hard to separate the wheat from the chaff, but if you have a good team, the process will be a million times better, because something's going to go wrong during the process and you have people that you can rely on, then it makes it that much better.
Yeah, I would agree. I mean, in my business, I partner with different professionals, and the ones I tend to keep going back to and introducing to my clients are those where either, they're great at educating my clients or me. Like, it's not, this is the credit score, this is the process. There's education behind it, because that's, the business model I have is empowering my clients to make informed and confident decisions. And so I align myself with professionals like that. But also, you said something important, which is, when something does go wrong, and often it does in our business, that's really truly when professional characters come through, right?
Yes.
And I've worked with professionals where it was just like, different personality and different people deal with challenges differently, right? That's fine. But I really appreciate someone who just kind of, okay, this is what's happening. Let's work on a solution. So I think you nailed it there. Anything else that you'd like us to know about refinancing or the mortgage world right now that you think is important before we close out?
Well, believe it or not, I get a lot of people that have 15-year mortgages asking about refinancing. If you're 2 or 3 years into a 15-year mortgage, doesn't matter if rates are a percent lower, it doesn't pay to refinance. Okay, just know that, and I'd be happy to share those numbers with somebody if they wanted to see them. Okay.
Got it. And that's because 15 years typically have lower interest rate to begin with than 30 years. So by the time you account for the closing costs and stuff like that, it may not make sense.
Well, and also when you take a 15-year mortgage, you take the mortgage to pay off the mortgage. So you have 180 payments. The idea is to pay it off. And even if you reduce the rate a percent and you're 3.5 years in, so you've got I don't know, 120 payments left or what have you, or 115 payments of 180 payment loan. The payments of the new loan, even with the interest rate, are going to exceed the total of the payments you have left. Am I making sense?
I'm gonna have to rewatch this whole thing, Mark. Makes sense.
Well,
that's a lot of math
really,
and a lot of technicality. So yeah.
Well, you just know that 180 new payments, the total of those payments for a 15-year loan is going to be more than the 150 or 140 payments you have left on the old loan. It's just
so it's best to keep it as is. Speaking of that, actually, you brought up something important. So closing cost, right? That's typically something that people can finance into the mortgage, right? Correct. So
yes, usually if somebody owes 400 on their loan, they're taking a mortgage for 405 or 406. Yeah. And you have to reestablish escrows. In other words, your taxes and insurance generally get paid through your mortgage payment, and there's an escrow account with your old lender. You have to reestablish a new escrow account, and that's going to be 5 months of taxes generally.
I thought it was 3, no?
Well, the law says 1/6 of a year they're allowed to keep in reserves. The lenders are allowed to keep in reserve which is 2 months. But we pay taxes quarterly in this state. So let's say you're closing your loan on October 6th. Okay. Well, fourth quarter taxes are due on November 1st. Right. You're going to pay those fourth quarter taxes at the closing table, and then 2 months will go into the escrow account.
I see.
Okay. And then your homeowner's insurance has to be at least 6 months left on that. So you probably got to figure that you're going to have to renew your homeowner's insurance.
Got it.
Okay, so that's, 12 months, a year of that plus 3 months, because at the end of the 11th month, we're paying your homeowners and we're allowed to keep 2 months.
Got it.
Okay. All right. And then you will get a refund from the old lender. One of the things. So in this instance, like we have loans closing in October and these borrowers are paying 5 months of taxes, they will probably get 4 months of taxes left and most of their homeowner's premium. One of the things to be careful of is that as your real estate taxes increase, your mortgage payment does not automatically increase. So sometimes there are escrow shortages, so they might not have the whole thing.
Good considerations. So those who are considering refinancing already have a mortgage, already have a relationship with a mortgage company, right? What are your thoughts around shopping around for mortgage rates? Or, most people, I would imagine, would kind of go to their current mortgage carrier to see what they would offer, including myself, especially if you dealt with, big banks where maybe your savings and your checking stuff like that is together and it's convenient. That may be where people look to. What are your thoughts around kind of shopping around and even potentially refinancing with a different mortgage broker or company than you originally had your mortgage with?
Well, the fact that a bank has your loan is a misnomer. The loan is with Fannie Mae or Freddie Mac generally. Okay. They service the loan on their behalf. The servicing department of any big bank is a separate entity from where your savings and checking are. Even where the mortgage company is that takes your mortgage application, it's a completely separate division. It's called mortgage servicing. Okay, they collect your loan, they pay your taxes, they pay your insurance, they pay Fannie Mae, they do foreclosures and so forth and so on. Okay. So let's say your interest rate is 3%. They collect at 3%. They pay whoever has the paper on Wall Street at 2.5 or 2 3/4, and they keep the difference. That's how they get paid.
Got it.
Okay. So wherever your loan is, whether it's, the big services like Freedom Mortgage or Wells or Chase, you should go shop around a little bit. Because we talked about overlays.
Mm.
Well, different lenders have different overlays. Maybe you don't, they bought your servicing 2 or 3 years ago. They never originated the loan or took your mortgage application. You might not fit what they're looking for in their mortgage company now.
Mhm.
Because when a company buys your mortgage, they've bought a pool of mortgages. They've probably bought several $1,000,000 worth of mortgages at the same time. They don't know what the individual loans are within their servicing portfolio.
So
In
it's
that,
worth to shop around and
oh,
see what's gonna be
absolutely it is.
offered.
Absolutely.
So don't be afraid to start a new relationship with a new mortgage company if it serves you well.
Right. Especially if it's called Sunquest Funding. And
Nice ending, Mark. I like that. All right. I think we covered, a lot of the big questions and questions that I myself had, when I was considering refinancing. And you helped me understand that, like, even though, there may be substantial, some meaningful savings per month, that over a period of time, depending on our goals, it may or may not make sense, which is actually the inspiration for this video too. A lot of people are talking about refinance and, even within our industry. And so, I thought this would be helpful. So thank you so much, Mark. Yeah.
I just want to throw one other thing out there that I just thought of. All our money comes from Fannie and Freddie. If your loan amount in North Jersey is less than 765 or less, it's got probably a Fannie Mae or Freddie Mac loan. All our rates should be about the same within an eighth on any given day. If you hear a rate that's really low, it's probably not real, or there's hidden fees or something. So
Or points, right? With points.
Right. If rates are higher with one lender than everybody else, they're probably turning off the flow. They don't want loans right now. But if somebody's much lower than everybody else, beware.
Got it. Thank you so much. And where can people find you if they want to reach out to you?
At my desk.
What are your contact information?
908-272-8330 and Yecies at sqf.net. That's MYECIES at SQF, like Sam Queen Frank.net.
Excellent. Thank you so much, Mark. And
thanks, Tez.
Tez Roro, I'm on all major social media. You can reach me under Tez Roro or Tezita Roro. Connect at tezroro.com is where you can find me via email. I hope this has been helpful to you. Let us know what other topics you're curious about, what other professionals you want me to bring and ask, or if you have additional questions about refi, perhaps that we didn't touch today. I'm happy to connect you to Mark so he can answer your questions. We hope that you are having a great time and staying sane and healthy. Until next time. Thank you, Mark.
Thank you, Tez.